Everybody, good morning. Tony Bruce, CPA, more than just an accountant. Glad to be back in the studio. Good to see you. And here we are at the end of August, coming up to the third quarter of 2024. As you may know, we have an election coming up, obviously, in November. And we're going to talk a little bit about what some of the proposed tax policies may have in terms of an impact on business in general and the economy. Here we are again. Couple of things like tax planning. Let's talk about tax planning. So, tax planning would be looking at things like this third quarter, looking into the fourth quarter. Your estimates for small business owners are due September 15th. So, keep that in mind. Interest rates are high as they've been in terms of what the government is charging, IRS, federal, New Jersey, California, wherever you are. Your underpayment penalties are in play here now. Government's charging 7, 8, 9%, depending upon where you are. At the same time, interest rates are not that high. So if you do have treasury, if you have money sitting in the bank in your business or in your personal, you're not getting that same kind of return on your dollar. So you have to be careful there and make sure you're making timely estimates. How do you do that? You look at cash coming in, cash going out. Who do you owe and who owes us? You have to have accountability. You have to have some kind of an accounting. In today's world, hopefully it's an online system, whether it's Xero, QuickBooks, or in-house if you're doing your own virtual network, where you can look at your numbers on a monthly basis. That's what we're doing right now. We're working on our clients, even though there's extensions coming up for September 15th and October 15th. We're working on being proactive for our clients in 2024 to get ahead of and see what's going on. So why is that important? Well, when you're planning, when you're advising, when you're being proactive, you have feedback. And with that feedback, you could make improvement, right? So you want to have accounting. You want to have an idea of where you are. You want to have an idea of what the trajectory is, up, down, neutral, slow, fast, etc. You want to have an accounting of what's going on. And then you could use that data, you could use that input as feedback for how you're performing, sales, costs of your business, whether it's food costs, whether it's employee costs, whatever costs are involved in your business, what your revenues are like, what your projected revenues are like to fill out the rest of the year. You want to have that feedback because only then can you make improvement. Can you make decisions about how to move forward? So having said that, what do we do with the upcoming election cycle? Well, right now we're working under the old tax laws from 2017, 2018. In a sense, right? So we are in a pretty benign tax environment, relatively speaking, which I would argue is what's kind of kept the economy somewhat afloat. Now, we know we do have some high inflation, and inflation is a hidden tax. It's a hidden tax on individuals. It's a hidden tax on businesses, and businesses seek to pass that on. I wouldn't go as far as to say that they're gouging, but they have to cover their costs. So they have to, in fact, increase their prices, just like all the manufacturers. Which brings me to price controls. If you go back historically and look, you don't have to look at me. I have empirical data. I have knowledge, right? I've been doing this stuff for 40 plus years. I have education as well. CPA, more than just an accountant. What does that mean? I was a CFO. Price controls generally don't work. What they do is they create a false level of scarcity. They put value on things that aren't really valuable. And then what that does is it makes the situation worse for everyone. So you can go back and look. There's many different economists that'll talk about that, but even the economists themselves, go back and look at the actual effect of price controls over time. It doesn't work, especially when you get into different kinds of economies that are not capitalist in nature. Second thing is drilling down. What about this tax on unrealized gains? If you're familiar with what we're talking about, is what that means is they want to tax the monies that are in your accounts that you haven't really sold the underlying assets. So you haven't sold the piece of equipment, you haven't sold your stock in whatever companies are your favorites. You haven't sold those, but the values have increased since you bought them. And so those are unrealized gains and they want to tax those. Now, I know they're talking about doing it on what they call the billionaires and billionaires and all that other stuff. But my experience in looking at this data, whether it's sales tax, income taxes, capital gains taxes, whether it's social programs, once you crack open the door, it's hard to pull that back. So who's to say that the threshold right now might be, someone whose value of their accounts are worth 100 million or 50 million? That sounds like a far, far stretch. But what happens 20, 30 years from now? What happens 10, 15 years from now when you go to sell your business, when you go to sell assets? If there are unrealized gains, It also makes the tax system more complex, right? Now, who's going to challenge whether or not the values have gone up? We're going to use real market data. But what about when the values recede? Does that mean we go back and give a credit if the values have gone back? Very, very difficult to implement. But it's also, you could argue, something that's a paradigm shift, right? That's the fancy word. We've never seen that in America where we've taxed unrealized gains. We've taxed capital gains when they occur. Second thing I want to talk about is this increase in corporate taxes. Increasing corporate taxes is going to make it more expensive for everyone. Make no mistake about it. If you're the small painter who's doing residential commercial projects locally in your community, if the cost of a can of paint goes up because the corporate tax has gone up, that tax is a tax on everybody. Employees will not have the same wage raises that they've had in the past because the business owners, believe it or not, are in business to make a profit. They're taking a risk. That's the American way. That's the American dream. So when you take that risk, when you put your livelihood at stake, when you put capital at stake to enhance your lifestyle, to make your business better, you're also making your value and your business better for your employees and your customer. Well, if your costs go up, you're going to pass those costs through your business. You're not going to be able to absorb them, just like we've had our costs go up. We've talked about this many, many times. Doug and I have these conversations before and after we do this podcast. Doug's an entrepreneur. He's here in the studio. He does all of our recordings and our podcasts for us. We talk about it all the time. He's like, what's on the horizon? What's coming up? What do you see? And we talk about what happens to the small business owner. Now, as a CFO for hire, as a small business advisor, a tax planner, someone who has experience in the trenches, rolling up my sleeves, having to make payroll, building out new locations, we now bring that to the marketplace for our clients, as we've said many times. When those clients are looking at and they're concerned about costs and there's uncertainty in the small business future, we've said this many, many times. Small business is the lifeblood of American dreams, of the American business place. Whether you're a farmer, whether you're a content creator, whether you're a sports person, whether you're a local body shop, whether you're a medical practice, these costs going up, these taxes going up on these businesses generally are not a good idea. All you have to do is go back. There is, and I hate to use this word because it's not really an economy. If you look at Thomas Sowell or somebody like that, they'll tell you that trickle down doesn't exist. But there is effect. There is a dropping of the rock. When you throw that rock into the water and the increase in taxes, it does expand out like a pond. Drop that rock and all those taxes go down the line. They trickle into our everyday wages, our food costs. They trickle into housing costs and the like. So here we are in an inflationary environment. There's talk about lowering the interest rates. We'll see. Is it too little, too late? It's somewhat awkward to lower the interest rates. Just like we found out that inflation wasn't transitory, now we're finding out perhaps that the interest rates should have been lowered sooner. We'll see how that all plays out. I know it is uncertain, but if you go back through history, we've changed presidents before, and we've had that overcome through ingenuity, through the American entrepreneurship, because we have a capitalist environment that unleashes the ability for us to go out and earn. But I'm a firm believer in my empirical data working with my clients over the last 40 years that a lower tax environment generally is better for everyone. It trickles down, yes, trickle down, negative words, but it is really what happens. The pond, the ball drops in, the rock drops in the pond. It trickles down to the employees. It trickles down to the cost. It trickles down to everyone. It makes life better. The more opportunities there are for people to work, the raises of wages happen naturally. They're not suppressed because of price controls. They're not suppressed because you increase taxes. We'll see how this plays out in the coming months. We'll see what happens in the next couple of years as the economy moves forward, as we move out of the post-COVID era, and what impact that has on small businesses. A great referral is someone who has a small business, wants to reach out. We offer a free consultation. I'm glad to sit down with you. We could do a Zoom call. We could do something in person. We work with people all around the country, all around the world, frankly, and we could do tax advisory. Take a look. We do a diagnostic of your business, see what's going on in your personal life, and project that out. and see if we're a good fit for you. Generally, our clients are saving money on a tax advisory business, oftentimes in the tune of 20 to 30% of their taxes. If you're paying a lower price to someone you're working with, you're really not getting a discount. You're just sharing your money with the government in the form of increased taxes. Tony Bruce, CPA, more than just an accountant. Reach out, like, and subscribe. We're grateful for you being here today, and enjoy the rest of the summer. Have a great third and fourth quarter, and we'll talk to you soon. Take care.